And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Today we tackle one of the big topics for 2021, environmental, social, and governance, or ESG. It's been raking in money this year. Will it do so in 2021? Our guest today, John Hale, head of ESG research for Morningstar. Linda Ellinglee is the global head of ESG research for MSCI. And Kim Arthur from Main Management, an old friend of ETF Edge. Thank you, everybody, for coming. Linda, I want to start with you. Could you just sort of sum up ESG developments this year? I find it rather extraordinary. 2 years ago, everybody was interested in ESG, and there was really no money attached to it. That's really changed rather dramatically. Your thoughts as we end 2020 and some brief thoughts on 2021.
Oh, absolutely. So 2020 has been an extraordinary year. We were not necessarily expecting this to be the year where ESG really takes off, but clearly it has attracted a lot of attention, both in terms of the companies and what they're doing from an ESG perspective, but certainly from a flows point of view. In terms of going into 2021, we did just publish our annual ESG Trends to Watch report, and really at the top of the list of what investors we think are going to be paying attention to in 2021 is actually the topic of climate change. And that's because, despite all the lockdowns that we've had this year, we're still on track for a world that is going to be too warm to sustain life as we know it, according to climate science. And so, I think that, the Paris Climate Agreement, which was signed 5 years ago, you're going to see lots more investors really shifting capital towards less carbon intensive assets. So I think that, one of the really big focus areas will be in climate change.
Yeah, I want to return to climate change and some other issues I think are going to be hot, like diversity. But John, I wonder if you could just comment on just the whole ETF business and what's going on with ESG in general. What's amazing to me is how much money some of these ESG funds, these ESG ETFs have attracted, and also just how diverse they are in the different performances. So, for example, I see returns for the 5 largest ESG ETF funds out there. I see iShares USA Leaders ESG, SUSL, is up 9%. And then I see the Vanguard ESG is up 21%. That's quite a different diversity in returns overall. Can you sort of address the fact that it's sort of hard to pin down exactly what ESG is when you're actually buying these funds?
Yeah, that's interesting, Bob. I mean, all ESG index funds certainly are not alike, and that's what we have on the ETF side of the ledger. There is our passively managed funds, but yeah, there is a range. I mean, it ranges from what I would refer to, and actually iShares has started doing this as well, to sort of ESG aware portfolios that are just they're sort of slightly tilted towards ESG, trying to focus a little more in terms of overweighting companies that do better on ESG measures, underweighting those that don't. And while other index providers and index funds are taking it a little bit further and maybe focusing more on ESG leaders, avoiding laggards altogether. Different ESG funds also have different exclusions that they use. So they can be quite different. I think the best way to think about it is that you can add ESG onto a number of different investment styles and approaches, and even in the case of indexed investing, it's sort of the same story there. So you can have kind of ESG light, a stronger ESG component, and you can also combine that with different types of underlying investments.
Yeah. Kim, you're the guy who manages money here. I mean, how do you address this problem? When a client calls and says, I want ESG or more ESG or less ESG and want some advice, what do you put them in? Do you have to ask what kind of ESG they're talking about? How do you as a money manager handle the diversity of ESGs that are out there?
Hey, Bob, thanks for having us on, and great to hear your voice. Yeah, that is the big gorilla in the room there. First of all, as John just mentioned, there is no, we subscribe to multiple databases. There is no easy button to screen for ESG. I could screen for sectors, geography, duration. Can't screen clean up for ESG. So what ends up happening is, since there is no standard definition, each client that comes in it's almost a bumper sticker. Some want exclusionary, they want no casinos. Some want single themes, they want food production or plant-based protein or lab-grown protein. And then some want just best in class where it's almost a relative game. So it's not easy, and I think that's one of the reasons that scalability has been a little more difficult, because if I go to my client, each one, again, like I said, that bumper sticker is sort of what they are looking for, and it's very unique and very individualized right now.
Yeah, so Linda, how do you address that? I mean, you're in charge of helping figure out ways to make ESG more available to people. Some people will say, look, I want to go back the old-fashioned way. I don't want tobacco companies and I don't want energy companies. Other people will say, well, listen, I want clean energy. So if Occidental Petroleum is doing more clean energy work or has a lower carbon footprint than ExxonMobil, then maybe we should include that in an index. There's not a lot of agreement on this. How do you address that? Or are you just comfortable with the idea, there's a diversity of voices out there, and let's see, what the public really wants?
Look, I mean, MSCI calculates over 1,500 ESG equity and fixed income indexes. And the reason there are so many and they're growing rapidly is because they provide choice. And they provide choice to investors who want different approaches to incorporate ESG considerations. Now, sustainable investments is just a very broad category. It's not a binary proposition of whether a company or a fund is ESG or not ESG. But now there are a number of industry bodies and regulators, particularly outside of the US, that are pushing to standardize the market towards a common language to describe some of the key subcategories that are under sustainable investment umbrella. And that's going to help allocators make choices. So for example, a core subcategory is ESG integration approaches. So those are the financially focused ones that are only considering material ESG issues, which ignore a lot of other ESG topics that some investors might care about personally, but they're not financially material. So this subcategory has probably gained the largest traction because they've shown strong performance. They don't necessarily entail too much deviation from the broad market returns. But then you also have ESG approaches that are designed to increase exposure to narrower themes like clean technology or diversity. So those are closer to thematic indexes or strategies. And then, as you said, there are ESG approaches that are more traditional. They're more ethically, oriented, and you can screen for businesses with activities some investors object to. Whatever that is, it could be child labor, it could be tobacco, and those. It's really important to know that those screens are not incorporated into indexes or funds with the goal of enhancing risk or performance, but with the goal of aligning with investors' ethical values. So it's really important not to mix the apples and oranges when you're talking about these different ethical strategies that may or may not have any element of incorporating financially material ESG factors. So I think the standardization around these subcategories of ESG investments, they are going to help allocators to be clearer about what it is they're choosing or not choosing with respect to both the ESG exposures that they're taking on, as well as the risk and return profiles that they should or should not be, expecting from any given approach.
Yeah. John, it sort of makes sense what Linda is saying. I mean, she's at MSCI, and of course, MSCI is investor agnostic. Their position is we provide the tools and you decide what you want. But I'm wondering what you see here. Is there any indication that investors want a specific kind of ESG? I'm just talking about follow the money. I mean, or do they want, as Linda said, some just want more traditional things. I want to exclude carbon companies that have bad carbon footprint or too high a carbon footprint, or is there new stuff emerging? What is the public indicating that they actually want, John?
Yeah, I think it's a great question and great comment so far. I mean, I always urge financial advisors to simplify this. I mean, one thing that I think has happened in recent years is we've seen more and more interest in sustainable investing come up is that the early adopters, the ones that come into an advisor's office and say, I want an ESG portfolio, I want a sustainable portfolio, they're the ones that are going to maybe thought this through, and maybe they do have a set of very specific sustainability preferences that they want to then, they want their advisor to then address for them. That can be hard because it creates, kind of a momentum for bespoke portfolios for every single client, and every single client can't really have a bespoke portfolio. But I think as this becomes more mainstream and more people just become, aware of the fact that, yes, I'm someone that has a sustainability preference, to the way that I buy any product or service out there. And I've learned that I could do this in my investments. That's really what a lot of people are bringing to the table now. And so what they're looking for from their financial advisor is them to say, okay, we can do this, and here's my recommendation for what you're interested in. So a lot of times I think when somebody has a specific issue that they bring up and they come to the table with, that may just be the only issue that they, know to bring up. It doesn't mean that they're necessarily going to be opposed, for instance, to a broad-based, diversified portfolio that emphasizes, ESG, kind of broadly speaking, and not necessarily focused just on a list of things that they, personally would want to excise from their portfolios.
Kim, same question for you. I mean, it sort of goes back to the question I asked you before, but what are you telling people? They want ESG. What are you recommending? What do you see they want? Does the public voting with their feet in terms of what style of ESG they want?
Yeah, Bob, definitely. I think there's clearly a huge overlap with ESG and quality and growth. That's good. And that means if we break the E and the S and the G up and take the two bookends, the E, the environmental that we talked about, that tends to be companies that are disruptive technologies that are doing something good. I'd mentioned before food production, plant-based protein or lab-grown protein. That's going to be less water that's used, less land that's used, less methane gas that's going to be emitted. So that's a growth industry because it's disruptive and people are moving that direction. And then when you look at the quality side, that kind of covers the G, the governance side. And again, it's historically been that governance is best practices. And that means, like for myself, I'm a fiduciary. And if I or the companies I'm investing in are treating employees well and treating the clients well and treating the community well, those companies are probably going to do well. And so I think what ends up happening from a broad-based perspective, Bob, people will come in and you look at something like DSI, which is probably one of the oldest ESGs, but it's 2/3 technology, healthcare, and consumer discretion. And it's a reason. Those are the quality and the growth areas that come out of it. And then if you look into the ESG emerging, the ESGE, which is only about 4 years old, well, that's overseas emerging. It's about 53%. It's actually outperformed its peer in the emerging market category. So we definitely have that. We've seen people for animal, pet care, PAWZ, PAWS, right? That's doing something good for themselves, doing something good for the animals. So I think we're seeing a lot of that, and we have a sector rotation strategy, SECT, that's the same thing, technology, healthcare, consumer discretion, about 2/3, and a lot of them are ESG compliant pieces.
And yet, John, am I being curmudgeonly by pointing out that among the largest ESG ETFs out there, they all own essentially the same things in terms of their top holdings? Look at the top 5 or 6 ESG ETFs, US-based. They all own Apple, Microsoft, Amazon, Facebook, Google, Procter & Gamble, Johnson & Johnson, Visa, and most of them own Tesla as well. These are all great companies, but there is a... Am I being curmudgeonly pointing this out? I think a lot of people will be shocked to find out that Microsoft is such an ESG favorite, and so is Apple, for example.
Well, I think it is true that when coming to the table, I think a lot of investors think that they may be asking for a really fundamentally different kind of portfolio than they would otherwise be getting in a standard, market-based mutual fund. But I think it's probably better to both explain to those investors, as well as just to think of it in these terms, that it's really, an investment first, and the ESG tilt is secondary to it. I mean, primarily what you're doing, it's like buying a Tesla. You're primarily buying a car, right? And so I think with your investments, you still need, and most investors still need, right, core exposure to major asset classes in the marketplace. And you can do this through traditional investments. You can do it with an ESG tilt. And the advantages, I think, of having ESG tilt are, as Kim mentioned, the sort of long-term quality component. I think if there's anything that ESG indicates, that's one of the things it does indicate. It also intends to include, or in terms of probably overweighting in most cases, exposure to the sort of cutting edge companies that are going to be delivering the products that are going to really drive a sustainable economy in the future. And then there's also this other component called that we call stewardship or active ownership or shareholder engagement that some ESG investments do more so than others, and this can be very impactful as investors are essentially pooling their money, and the investment manager is engaging with companies about their ESG practices, encouraging them to do better. And we've seen a lot of indications that's been successful. It's been happening more often. The proxy voting is more. There's more shareholders voting proxies in favor of ESG resolutions now, and so that's a differentiating factor that could also be, that could also come into play in selecting investments that are ESG oriented.
I think, just to conclude my curmudgeonly commentary on this, I'm not the first one to notice that the biggest ESG funds tend to mimic quality funds, QUAL, that kind of thing. And that probably is a good thing, but I stand by my assertion that a lot of people will be very surprised to find out that Microsoft and Apple and Google are favorites of the ESG investing. Linda, let me just move on to you. Before we conclude, I just want to get your thoughts on another key area of ESG, and that's diversity. So NASDAQ announced diversity targets for their boards of directors or companies that list on NASDAQ. The theme here, they seem to be trying to nudge companies along on the diversity issue and hiring women on the board. Linda, what did NASDAQ do, and how successful do you think that kind of nudging is going to be? Is that what we're going to be seeing in the future, that kind of action?
Well, the diversity push will only get stronger. I think the NASDAQ move is one example of that. Now, oddly, the progress actually has been extremely slow, even though we've already seen this kind of push for several years. So our research team at MSCI just published our annual Women on Boards Progress Report, which we've been doing since 2009. And what we've seen is actually there's been a slowdown in the rate of increase for female representation on boards, with a gain of only 0.6 percentage points among constituents of the MSCI ACWI Index. And if you take this kind of trend of progress over the past 4 years and you project it forward, it's going to take until like 2029 for women to comprise 30% of the corporate boards. So I think that the kinds of moves that you're seeing at NASDAQ and maybe among some of the larger institutional investors that are agitating in some ways to push progress along is because the progress actually has been pretty slow. So I definitely think that this is an area that will continue to get a lot of scrutiny.
So Linda, we hit briefly on environmental and we hit briefly on diversity. What else in 2021 are going to be hot themes? I mean, that seems to be very clear: environmental issues, climate particularly, as well as diversity. Those seems like very obvious hot topic buttons for 2021, particularly with the new administration coming in. But what else might be on the broad ESG palette that could come to the fore as a major issue? Anybody can jump in, but Linda, let me start with you.
Well, I think that diversity is the one that is really specific. However, the larger topic is really around inequality more generally, right? So COVID has had this effect of really shining a light on the health and the economic disparities in our society. We expect that the incoming administration's focus on economic inclusion and on social issues is going to mean that companies should not really take their social license to operate for granted. We have seen this year that investors, of all sizes, from the largest pension funds to retail investors, they care about how companies treat not just their workers and how diverse their workforce is, but whether their businesses prey on consumers or suppliers, or whether they actually create value that is shared across stakeholders. So we think that this is really actually going to amplify and intensify over the coming years. And in response, what we're seeing is that companies are going to get more creative about how they can actually better beef up their social credentials with investors and the public, and maybe actually get out of the crosshairs of policymakers. You're going to see, I think, growth in new types of financing instruments, like social impact bonds or sustainability bonds, and even sort of share issuances that are linked to sustainability goals. So these are ways that companies are taking to make a more direct link between its business and the social value that it brings more broadly.
Hey, Bob.
Okay, John, any finer
addition?
Sorry. Go ahead, Kim.
I was just going to say just one other thing on just one other thing that what Linda was talking about. If you think about the inclusiveness, and I'm looking at the big globe as a whole, 7.7 billion people, 4+ are connected, 3 are not connected yet. Again, it drives towards technology, connecting these people, bringing them into the ecosystem. We've all seen what a Siri or a smartphone does when you take it out to somewhere, to a small village in Africa, and all of a sudden there's somebody who may not be literate. All of a sudden they can move up the food chain dramatically by being able to talk and get things done. So I think, again, that's why it drives towards the future. Technology keeps playing a bigger and bigger role because it's enabling more inclusiveness and a broader reach.
Okay. Thanks very much, guys. John, appreciate it. Linda, Kim, always a pleasure to talk to all of you. We want to ask John to please hang on, because we're going to be speaking to him for a few more minutes on the ETF Edge podcast about some interesting developments in 2021 and how, for example, the SEC might be trying to get more ESG involvement in the areas that they cover, which, of course, is supervisory roles over the U.S. financial system. We're part of the U.S. financial system. We'll be talking about that, so tune in for that. And then again, we want to thank you for all of your participation and watching in 2020. We are dark for the next 2 weeks, but we will be back with a new edition of ETF Edge on January 4th. Everybody, until then, everybody have a healthy, happy, and safe New Year.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.